Hello and welcome to the Investing Master Series. My name is James Boyd. We welcome you on this Tuesday morning. Today's date, July 28th. Does anyone have a birthday today? Let me know. My son's birthday is today. He's 28 years old. And how the time flies. Let us know if you have a birthday this week. I don't want to leave anyone out. Just real quick, we'd like to welcome Grace with us, Josh, Pink, Kevin, Gary, Will, Sia, Texan, and many others. We also have with us in the chat Barbara Armstrong. We welcome her as well. Now, also, just real quick as we get started, got some questions that came in, and we'll hop on that as soon as possible. So just remember that Barbara and myself, we do post educational content on X. Let me show you where that is. This is my page right here, and I'll just kind of back this off for just a sec. There's my page. Barbara will post her link in the chat. That way you can click on it and follow her as well. Now, quick reminder, if you're watching this live, or on recording, just always remember that we have if you went to youtube.com, type in Trader Talk Schwab Coaching Webcast. You can actually watch our webcasts that are being broadcast on YouTube. You do not have to be sitting at your computer. You could be on an iPad, a phone, Apple or Samsung, whatever, okay? You could just watch your class right on your phone, okay? Now, also remember that those classes are live and recorded, many of them. I think there's two that are not, that are ETF based, but the others are. So check those out. Now, yesterday we talked about a class called Income Value and Growth Lagging. I'm going to share that with you in the chat. Let me just put that right there. Make sure that you go over that. That's going to be that was kind of like the setup for this week from what we saw. You'll see from this morning's action kind of more of that theme, and we'll get to that. And you have questions. I know I'm going to get to that. Now, also want to give us a quick reminder that for this class, there is a playlist. And so this class, here's the playlist for this class. Feel free to bookmark that. That way you can actually go back and see previous episodes from this class on the topic of the Investor Master Series. Now, hop right in. Remember that with what we talk about, it's done for general informational purposes only. Our examples will be stocks and options. Understand that our options that we look at will be kind of more basic options. That doesn't mean they're bad. It's just not going to be multi-leg option strategies, advanced options. Understand that when we talk about options, options are not suitable for all investors. Different option strategies have different characteristics to them. You want to know kind of the ins and outs of those strategies. See if it's something you would consider. You said, I'd like to learn more about ETFs. Brent teaches that on Monday afternoons. And I teach that with Kevin on Friday morning, 9:30 a.m. Eastern. Those ETF classes, if you're interested in those are when those are, Monday afternoon and Friday morning. Now, also remember that our examples would be done in the paper money software-based application. And also remember that investing involves risk, including loss of principal. When we also talk about, let's say, short options, something like a covered call, something like a cash secured put, understand that those could be assigned to be sold or purchased prior to expiration, regardless of the in the money amount. We're talking about American style options where that could be the case, not European. Now, also, when we talk about examples, we'll hop right into the market. I want to kind of start with kind of some of the routines that we normally look at. We'll do it quickly because it's going to be kind of a continuation, and then hop into examples of stock and option examples. Now, first thing that we noticed, and I'm going to kind of pull up just real quick. I'm going to pull up this chart. Okay, now this one, we're going to type in IXR. IXR. Okay, there. Now, this morning I woke up at 4:30. And I cannot tell you the last time that I saw Staples gapping in the pre-market. I mean, I have a pretty good episodic memory. I couldn't tell you the last time. Okay. Staples, which by the way, I posted on X, not a recommendation. But the thing is, what you saw is right off the start, Staples gapped. Now, hold on. When you're talking about Staples gapping, we're talking about, let's say, we could say healthcare with that. We could say real estate with that. We could also say utilities with that. Usually that's more of a sign of defensive posturing from growth. Okay. Some investors also wanting lower beta names, something that's not as correlated to the S&P 500 historically. Maybe want something that also has some income potential, dividends, etc. Also understand that those dividends are not guaranteed indefinitely. They can change the dividend policy. Okay. IXR led the charge right out of the gate. Okay. So let's just start there. The one thing we also want to kind of say is when we look at, let's say, the number of stocks, the percentage of stocks, excuse me, that are trading above their 50 period moving average, this is what's going to just blow people's minds. Okay. Welcome to the market. Okay. The percentage of stocks trading above their 50-day SMA hit a brand new high in the short term. Okay. Now here's the thing. What confuses some people is they think, well, if the market goes up, everything has to go up. That's not true. Okay. It's not true. Okay. Not everything has to go up. Okay. Now, if you look at the percentage of stocks above their 50-day moving average, brand new high, that's also on the 200 period moving average. That's also to a brand new high. 71% of the stocks trading above their 200 period moving average. Now, the equal weight, this is going to blow our mind. Everyone ready? Okay. The equal weight, this is called know your products. This is called know your holdings. Okay. So if we've said this for weeks, we'll say it again. We said before, if someone says, look, I'm not bullish technology, they might buy the equal weighted or consider buying the equal weighted because it's not top heavy technology. If they said they had more of a bullish outlook on technology, they would probably not buy the SPX EW per se. They might buy the product or consider it that actually is more focused on technology. Okay. Today we saw the equal weight that is not top heavy technology hit a brand new high. Know your products, know your categories. Now, when we actually take a look at also the Dow Jones, I'm going to fast fire these. Dow Jones, a little diagonal break. Okay. Now we got it. Remember Lisa asked that question on diagonal breaks. Okay. When does maybe the investor trust it? Maybe not as much, right? Well, the moving averages actually here did cross so far today. But let's just verify what we're seeing on that 3-year weekly chart so the investor might not be tricked. Well, if we go to that 3-year weekly chart, what do we see here? Remember we said before is that at least, at minimum, we should say, the investor would like to see one of the moving averages at least green. The 20 period is, 20-week moving average is. The 10 period, not yet, okay? But at least on the Dow Jones, one of the moving average. That was the minimum criteria, okay? So if someone says, look, I'm trying to trade at maybe an index, when I say that, a product that's tracking the index, they could actually say maybe the Dow based upon the moving average crossover on the daily chart, but also one of the moving averages green on the weekly as well. Now, if you look at the SPX, you would think the SPX is just bloodied, okay? Not really, okay? It did drop down, flatten off, just don't see participation. That actually means that something is offsetting. Now, when you actually go down a little bit, just real quick, and look at, let's say, the NASDAQ, this is where, well, there's some feelings being hurt. This is why we say comments like, if the price is below the shorter term moving average, the path of least resistance is down. What's the forecast? The forecast is pain, okay? Probably not pleasure, not if you're bullish, okay? And so what we saw is we broke through the 23. The red moving average line had been flashing red for days, not literally flashing, but just figuratively, okay? And you're seeing that we just fell down to the next support level. The bad thing about the NASDAQ and the semiconductors is you don't see a whole lot of support. So now we're not saying that the NASDAQ is never going to be bought again, but we probably need to go down to a support area. Now, I am not saying we're coming down to this area, but really that area that we really had the old breakout level is 26,000-ish, okay? Now, if everyone and their mom and dad is looking at the same area, it might not go down to that area. But if we're talking about right now, well, probably path of least resistance, 26,814, okay? That's the first level. Why? Because we got down below the 38 today. And so the second level being the 61 fib, which is 25,900. When is the NASDAQ going to stop going down? When you reach a support level, okay? And right now we're blowing through support levels, not actually bouncing off them. Now, when you also take a look at the SOX, which has been really the anchor off the back of the NASDAQ boat, if you will, new low here today. This green shirt is not for the semiconductors. Let's be frank, okay? So, what is the green shirt for? Funny you should ask. We already brought up just real quick the staples. And that size of a candle, that is like a ladder, okay? Again, this always goes back to three categories, right? Growth, which we kind of categorize as, or sectors that would be in the category of growth would be, again, tech, discretionary. Those two main ones. You could say energy and materials. Those four we would earmark underneath growth, okay? When we talk about staples, okay, or when I say income, we're really actually think dividends, think staples, healthcare, non-biotech, utilities, and real estate. Anything else that would be in value is probably going to be more industrials, transports, and financials that would actually really be more in, let's say, value typically. They don't typically trade at a high price multiple, okay? Now, I'll leave it at that. We saw, for example, staples push, healthcare push, communications, it's up on a percentage, but not as strong as the others. Real estate, doink. Hello, okay? And you're going to see utilities. Now, of the four, okay, staples, healthcare, real estate, and utilities, which one is lagged? It's utilities. Could that start to kind of move to the upside? Now, you got some tailwinds here, okay? You got crude oil actually finally dropping a little bit to some degree. You see actually interest rates 4.60 dropping down a little bit. What's interesting is we do not really see the VIX spiking to the upside. And maybe we barely got the VIX above 18. And the last one, but not least, the US dollar, okay, was the peso, now the US dollar, has not broken out, but kind of still high. Probably of any of those that looks a little high, probably the US dollar, okay? But we don't see any of those bearish sentiment gauges. The dollar, the rates, the VIX, the crude oil, we don't see anything like super spiking. The only thing that's just being the main culprit, dragging things down, is the semiconductors. And we don't have a whole lot of semiconductors, if any, okay? So that hasn't really been the issue that we've talked about. Now, just real quick, okay? Now, here's the deal. Comment says from Lewis, do I ever, I'm not sure do you ever compare relative strength versus the S&P 500? Well, we visually look at it, right? Do we put all those tickers on a chart? No, okay? The way we look at it is we put them in a list and then we compare it. So this list, when we look at the sectors, what I'm looking at, and I look at the 1 week performance, I look at the month, those two first. Remember, the week we're actually looking, that would be like the bull flag pole, think momentum. And the month, we're actually looking at the month for trend performance. Now, so we're looking at statistics, statistical up or down, okay? Positive or negative. So where's the benchmark? Well, the benchmark, we're actually using SPX as the benchmark. I'll put that right there, okay? Highlight that. So the S&P 500 is down not even 1%. I know it seems more, but it's not. And if we look at that, anything above that, gold, energy, industrials, anything above that, stronger performance. That's one way to super quick to see relative performance. Now, if you actually want to see relative strength on different durations of time, not just 1 week or 1 month, that is where we go into the RS columns. And you're going to see that really healthcare has really been green. Staples has been green, different durations of time. We see real estate is also, utilities has been green, real estate has been green. The one that we have not made mention of is the financials. And you're going to see that they've been outpacing. This is the performance of those sectors compared to the S&P 500. So those are two ways to do it. Okay. All right. Oh my gosh, Dean, I knew it. How could I forget? Dean always has my back. Yeah, let's go back to this one just real quick. Oh my gosh, everyone, moment of silence. Okay, Target. Okay, now Dean thought I forgot about that. I did not. I had that written down, but I was saving it. But Dean let it. You just put it out there. Now, let's go to this just real quick. So yesterday we talked about Johnson & Johnson, Expedia, Philip Morris, Altria, and I'm missing one. But I want to bring up just real quick what Dean is talking about, and I think it's going to be right there. And what you're now going to notice is there is a position, shares, target, got a little pop here today. Now, we did the other day, now this must have been 2 weeks ago, and it was, we sold one contract of the 150 call. Now, today, we actually see that as the stock goes up, the call loses value because it has a greater chance to actually expire in the money. Hence, the option price actually goes up. And we see overall, since then, we're down 65 bucks. However, when you look at the gain in the shares, 710, and the loss on the call, unrealized, 167, still net for the day of target, $543. Not a bad day. Now, Dean, you're also missing one. Tell me the other one. It's Coca-Cola, okay? Now, Coca-Cola has just been this boring stock, okay? Bought some shares at 83.80, got a little doink on the earnings today. Not a bad little pop. Now, I'll show these, and then we're going to look at some examples. Now, James, you might be saying, James, go back to Target just real quick. Why not just take off the covered call? Well, actually, all this is really done on Target is just to go back to the diagonal line again, okay? And again, our call on that is we said, hey, we're going to agree to sell those shares at 150. It's not just at 150. It's we agree to sell the shares at 150, but we also get plus the premium. So if someone wants to give us 150 for the shares and give us the premium, go for it, okay? So I'm not going to buy the callback at all. Going to say, hey, still got the upward trending stock plus the premium. Earnings on that is really on August 19th. So I'm just going to stand down on that. Got about 2.5 weeks left and still got some upside on those shares. How much was that premium? Funny you should ask. The premium on that was $390. So it can make up to $150. That's where we agreed to sell the shares at from now until expiration, the time we sold it. And now we also get the $390 plus. So it's like we're making up to a potential $153.90, which is not even on our chart, okay? So we're going to hold on to that. Now, now Coca-Cola, if we went back to Coca-Cola right there, let's see what that looks like on the chart, Coca-Cola, and then we're going to look at new examples. Coca-Cola, there. And hey, now you might be saying, well, James, those shares of stock over the earnings, don't you think that's risky? It could be, sure, okay? The thing you also got to remember is every company's earnings is not the same, okay? What Apple comes out with or Amazon comes out with could be drastically different than, let's say, Coke, Pepsi, or Dr. Pepper, okay? These are more kind of staplish type companies where they don't tend to fluctuate as much. Now, that earnings, you had 50, I mean, this is just 2 earnings ago, 58 cents, 86 cents, okay, actual, and then you had 97 cents. Now, they forecasted actually 92, got 97, but a pretty good push here for Coca-Cola. Now, remember, some people say it's a boring company. Not everything in the portfolio is supposed to be a ping pong ball, okay? Sometimes you just want something where it's kind of more like a utility, where the company has a good chance to actually have revenue, earnings per share, and cash flow, okay? And just grow the business. And so Coca-Cola getting some help. Now, if we were to look at, let's look at some new examples here, okay? So we kind of looked at the market. I'm going to come back to just real quick. Let's talk about these areas just really quick, okay? So first off, I want to kind of go look at, let's say, the staples. Oh, gosh. Okay, sorry. Okay, now the one that we did not make mention of yet is the one, okay, Philip Morris and Altria. Now that Philip Morris and Altria, we talked about that. Those are dividend-paying companies, all right? Now dividends not always guaranteed indefinitely, but we talked about those companies. Could those be next? It's only $10, okay? I know some people say it's not much, but $10, okay? It might be something for others. Altria, which was lagging a little bit here today, also got a push. Now, Altria actually has earnings. Now, I'm going to start with Altria, okay? Now, yesterday we bought some shares of Philip Morris, but we're going to go to Altria. Now, you might be saying, yeah, it has earnings coming up. Noted, okay? Now, those earnings 144, 145, 130, 132, and you're going to see those dividends have really been right around 106. That yield, okay, if we pull up the dividend yield, what is that dividend yield? That dividend yield is 106. The yield, 5.57. That 106 is the quarterly dividend, okay? So if you times that by 4, you get about what? 424. 424 divided by in the current stock price, you get that yield expressed in percent. So now that yield, this is what's kind of interesting is the investor might be thinking, could I get stock appreciation and maybe a dividend? Now that dividend is not going to be paid out to probably mid-September. So this is not right around the corner per se. But the example that we're going to do is we're going to right click on the chart. Okay. And I'm going to bring that up right in the paper money. I'm going to type in trade number 1. We're going to right click on the chart and we're going to go buy custom and I'm going to go with stop. Now, I can hear someone, okay, saying, how high is this? Well, let's go back. Let's kind of use the envelopes to gauge the gap. Well, remember that light blue line is your 10-day exponential moving average. The yellow line is 3% above. Now, to get a signal, you typically need to get, let's say, 1 or 2% at least off the moving average to get a bounce signal or a breakout signal. So it's not completely unusual to buy maybe 2 to 3% above the 10-period moving average. And here we are, okay? So we double checked it. Now, what does PM look like? Well, just to see the difference. Well, why didn't I look at PM like today? We looked at it yesterday. Well, PM is literally 7%, okay? Now, that doesn't mean it can't go up, okay? But it's just a little bit higher off support. We're trying to look for something a little bit closer to support. Now, PM, go back to the MO. We actually have the position down below. The shares, we're trying to purchase those shares at 76.06. Stop price, 75.05. That's just default of $1 below the entry price. Now, if I were to look at this support area, we have 2 spots here. Number 1, where did we actually pull back to recently? 72.26. And the secondary, lower, $70 flat. Now, we like to kind of just run the basic numbers, if you don't mind. And we're just going to run these numbers, okay? So if we said, what's the current price? $76 flat, 72.26. That's going to give us a stop at 70.81. Forecasted risk in terms of dollars. So the reason why we say forecasted is the stop does not guarantee to be sold right at that price. It could be sold lower. It's a market order. Now, if we said, what's the percentage, including the stop, okay, not just how far we're off the support level or the moving average, it's also how much risk we're taking potentially below that. In total, forecasted, 6.82. Now, if we look at this, I'm going to type in that stop at 70.81 dated GTC. So trade number 1 example, buying those shares. Now, could it buy? Let's go back to this. Wonder if we did a full position. What is a full position? Well, that account is sitting at 59. So what I'm going to do is I'm going to go full. Okay, I'm going to go full, 5,900. Now, 5,900, when you say full, what does that mean? Well, what that really means is it's buying, if we could buy up to 10% of the account value, that'd be 5,900. Okay. Now, yesterday we did some examples where we were only doing half positions, about 2,900-ish. Now, what we got here is $76, 70.81, confirm and send. Now, remember how the stop works, okay? Remember how that stop works. Now, you also got to remember something is the cat somewhat is out of the bag. What do we mean by that? Its competitor, Philip Morris, announced earnings. The businesses like MO and PM, very similar. Now, Altria, could come out with some earnings drastically different than PM. It could. It could also come out with some news about the company itself, maybe what the viewpoints it has about the some different news than PM had. So don't think that PM announced, so therefore everything is perfect on MO. That's not true. You still have individual company risk, okay? But some of that might have been sedated a little bit by what PM did, and there could be some historical correlation between PM's earnings and MO, where companies or investors feel a little bit more comfortable that, hey, MO's earnings might be fair. Still don't know all the details. Now, what I'm going to do is send the order. Now, here's the deal. So I made a comment yesterday that what is the favorite sector? The favorite sector is the one that's going up. We're not locking on to any sector, okay? We're not just putting all the eggs in the technology basket. We're having more of a balanced approach of 3 to 5 sectors where there could be obviously some growth, but also we know that growth is not always the only area, which we've been saying for 3 weeks. And so we saw this morning the income area, if you bought the category, hit a brand new high. We also, for example, saw that when I say that, I'm saying the income areas include the dividend aristocrats with that, but you also have to include the value category as well. That hit a brand new high here today. So if you're just talking over and over about what about semis and what about semis, you're probably locked on to just one area. That's not the whole market, okay? Now, what I want to do is also I want to go back to when we also take a little couple of these healthcare names. I'm just going to go around just real quick. And by the way, let me go back to something real quick, okay? So when I go back to MarketWatch, we talked about the PM, we talked about the Mo. So now we have both of those, okay? The one also that we talked about, which we already have, is the KO. Though we have also we have Dollar General, okay? We have Dollar Tree. So we're kind of smothered actually in this area. Now, if I said, are there any two that we might keep an eye on? Now, the ones that are a little bit slower, Mondelez, okay, just we're going to keep an eye on that. The other one that we're going to keep an eye on is Colgate Palmolive, okay? That kind of looks like it has more of your classic flag pattern. I'm going to come back to that in just a sec with an option example. Casey is another one, General Stores, that actually kind of has your classic W pattern. Now, if you look at that on a weekly chart, which we don't typically talk about that, but it's been there, that has been tippy-toeing all over the moving averages so far this week. Do not forget about Casey's. Now, let's go back to CL for just a moment. Now, a lot of times we actually think about, let's say, some of these staples names, we're thinking that, oh, you have to trade a stock. No one said that, okay? Now, you got earnings coming up on this July 31st. So we're coming up in, 3 days. Now, this little flag pattern that we've actually been seeing here and there's the flag. Now, again, breaking out, that breakout doesn't mean a whole lot per se with earnings 3 days from now. Understand. Now, what you're now going to notice is this flag, we've kind of been tippy-toeing all over that 90-ish level, with 99 being the prior high. The high is potential resistance. We talked about that, okay? The low is not support. A high is not a resistance. A high is a high. A low is a low, okay, until retested. And you like those tests, whether it's lows or highs, being 2 weeks apart, okay? Not 2 hours, not 2 days, 2 weeks. Now, if we looked at this Colgate Palmolive, I just want to kind of look and see what do we have here. Now, so far, you've had 1.4 million shares traded so far. If we look at the options on this, we got a 30 implied volatility. And what I'm looking at is just I want to see what's the spread on the at-the-money call and the put. Well, the at-the-money call, 285, 330. You actually got, in this case, on the put side, 225, 270. Those are pretty wide, okay? You do have some open interest, but really kind of the bid-ask spread is tighter in the September expiration. We're going to go down and actually look and see where we see that liquidity. Now, remember, liquidity could actually be seen in open interest, volume, and the bid-ask spread. The tighter the bid-ask spread, the more activity currently. Now, what I'm going to do in this case is we're going to right-click right on the 92.5 call. We're going to go buy, and we're going to go to where it says Caller Synthetic. And I will share the package of charts. Yes. Now, if we buy the call, if we sell the put, what is that? Now, wait, that's two single option orders. That's true. Buying a call, bullish. Selling a put, bullish. Now, if we do this, what you're now going to see in this case is we're buying the call, unlimited upside, okay? And then you're selling the put at 92.5. Now, if you did this, what's the risk of this? The risk is the shares of stock could go all the way to zero. Okay, so that's the bad part. Now, what does it cost? The debit, like coming out of the pocket, like a debit, well, it's $235. The break-even expiration is really going to be right at 92.85. 94.85. So where are we now? We're like 50 cents below that. So we need 50 cents. That's like a half of 1% of the stock price in the next 52 days. Do we think we could actually go up a half of 1% in the next 52 days? Maybe. Okay. Now the max lost 94.85. Now here's the deal. We're going to do this. Let's go back to paper money. In this, what we're going to do is we're going to sell the put. So we're going to kind of take this a slightly different. We're going to do the trade that we talked about, but we're going to do the vertical first. And I want to kind of take a look and see what we have here. So if we kind of said, what do we have? When you go out of the money, like that one, 30 cents wide, 40 cents wide, 45 cents wide, 55 cents wide. And in this case, you really have about 40 cents wide. We're going to sell the 92.5 put. Now, if you sell that 92.5 put and you buy a downside put, you're trying to make it where you have the obligation to buy at the strike that you're selling and the right to sell at the strike that you're the 92.5, you're selling that. You have the obligation to buy those shares at the strike price, and you're buying the put, which means you have the right to sell the shares at the strike price. Let's think through this again. Selling the put, obligation to buy. Buying the put, the right to sell at 75. Well, why would you do that? To cap the risk. The other thing is to tie up less capital. Okay, that's the other reason. Con about that is you're actually in this case, you have a wider bid-ask spread. You're also paying a commission to buy that 75. Some people might say that's a small amount, considering you don't have to tie up nearly $9,000 to sell the strike of the 92.5. You decide for yourself. You're sharp people. Now, what we're going to do is this is a cap. Okay, you have a cap gain there. So what we're going to do is we're going to say, could we use some of that credit, the 227, to help buy the call? Well, funny we should say that. We're going to come down to this first trigger's SEQ right there, change that, and we're going to come over here to the call, and we're going to go, let's say 520, going to click on that, and we're going to make sure that we go somewhere in the middle. Now, where is that middle? It's right at 495. So we really have a cash secured put with downside protection. And then we have a long call. Now, if we plotted this on the risk profile diagram so we can kind of see what it looks like what you would expect, right? You have a maximum gain, okay? The credit. You have a maximum loss, hence a vertical spread. But that's just the vertical. But what about that long call? Well, the long call is going to give that potential upside. Now, if we all of a sudden we start getting more and more focus on staples and these income type trades, they might come back to this Colgate, among others, Clorox, etc. If you take a look at this, that long call, when we add that on there, uncheck it, there's the vertical, check it, there's the upside potential. Now, when we actually come back to this, 98, is that really the target? Probably not. Probably thinking a continuation pattern on Colgate. Now, here's the deal. You don't always have to come at this and say, I got to do a stock trade. No one said that. Okay? It's funny what we just kind of assume, and it's not even true. So in this case, we're actually doing a long synthetic. The put side is really more of a short, wide put spread with downside protection. How much money is tied up in this trade just in case to think about what is the max loss given this trade? The answer is 2,000. That's if the stock were to close below 75. Okay. Break even expiration, we're really looking about 255. Okay. So it's 92.50 where we have the right to buy those shares. Debit overall 255. We need 95.05. Can we go up 70 cents from that expiration? There might be a chance. So we're going to look and see if this actually can't get a move here. Now, notice that this also has earnings coming up. Noted. Okay. Now, obviously, as you go over earnings, you're kind of hoping just no whammies, no whammies. No, please don't gap. If you gap up. Don't gap down. Okay. Don't give us any unusual information coming out where investors are affected negatively. But we're going to see if we can't do this trade over the earnings and see how that actually plays out. Now, if we go back to also one other stock that I want to kind of make mention, I'm not going to do this example, but I mentioned on X that Dell is really at risk of breaching support. Keep an eye on that. If there's one stock that might try to go down among the other semis, SanDisk, WDC, Seagate, Micron, Marvell, AMD, you name it, LRCX, which all blew to the downside. If we said which stock might kind of be looking down support and we're seeing bubbles below the ice and at risk of dropping down below there, it's Dell. Keep an eye on that. Okay. Now, I also want to go back to just real quick one other stock we have not made mention of. I'm going to show just real quick the S&P 500. Let's go back to healthcare for just a second. Okay. Now, if we looked at healthcare, Johnson & Johnson, we did that example yesterday. I don't have anything to say. Merck, I believe we already have that example. Okay. I know some of you were talking about Abbott yesterday. Check me on that. Medtronics is actually trying to get a move. Amgen, we already made mention of. Are we missing any? Okay. Type it in the chat. Now, I want to move just real quick to utilities for just a second. Now, sometimes, not always, but sometimes when utilities, if it does get some attention, tends to be the one that has the higher beta, higher volatility. Hold that thought for just a second. The other area that I don't have anything to say is in the real estate area, which we actually have in the paper money account, it actually dropped down 2%. It had earnings with a big run. Okay. Simon Property Group, PSA, EXR, those have been the ones that have actually gotten a little push here. I don't have anything to say on that. Now, always remember, the investor does not have to buy individual stocks. They might consider buying the neighborhood itself. When I say the neighborhood, the industry group. Is there a ticker that is tracking the industry group? Is there a ticker that's tracking the sector? And it probably is. Okay. Now, I want to go back to just real quick the utilities. Now, yesterday, we pulled up a stock, EXPE, and someone, might have been saying, oh, yeah, this is foolish. Let's wait for it to break resistance. The problem with that, a lot of times, is when people say that, and I've said that too, a lot of times there's a way to kind of sometimes see, is there an increasing chance to break resistance? Such as if we have a resistance, okay, you might really see like a bull flag pattern where the stock runs up, pulls back, runs up, pulls back, runs up, pulls back. The investor is focused on resistance while not really giving proper respect to the higher lows. Now, if you're in a sector, an industry group that's going to the upside, and you're looking at a stock that's made higher lows, and the stock is pushing up against resistance, well, the stock could actually be drug up, as well as people are bullish on a sector or industry group. They're saying what stocks typically have a correlation to those groups moving to the upside. Okay. Now, EXP was purchased yesterday. The stock got a push yesterday and then gapped here today. If we looked at it today, we would say, oh, yeah, too late. So that's why we're actually looking at also stocks that also have what we call bull flats, where the stock has run to the upside. And instead of actually the stock kind of pulling back, it's kind of more of a stiffer consolidation. Stiffer meaning there's more horizontal supports. Why did I just go through that? Well, we're going to go back to the example of knee. Now, Bill is not allowed to talk about this. When you look at knee, okay, Nia's gone back up to the area of resistance. Now, resistance is right here. Where? That resistance is right around 90.17. Now, these type of setups are kind of interesting. I don't think people really look at it like we talk about it. Well, number one is if you get, for example, a stock breaching resistance, number one, new investors could be looking to trade that, maybe invest in it. Number two, investors that already have the position might add to the position. But the third, and don't forget, those investors who are bearish, they're short shares, they might be buying those shares back or tried to get out of the position. And fourth, those who are short, they might try to get out of the position and go from bearish to bullish. Okay. Now, some of you might say, I understood the first two, but not 3 and 4. If you've ever been short shares of stocks, you know what I'm talking about. Okay. Now, what we're going to do in this case is we're going to right click on the chart, buy custom with OCO bracket. Now, remember, if the stock breaches resistance, the path of least resistance, maybe like the EXP, could it happen? We don't know. Okay, about ready to find out. So if all of a sudden we start getting utilities to push to the upside, what utilities tend to have maybe higher volume, a higher beta? If some investors say, look, I want to kind of trade these. Well, go look at which ones have the higher beta. You can pull it up in the list and see that, also see the implied volatility if you wanted to. Now, if we look at this, I'm going to put a target right in the middle, about 96 and change. Now, that support level, I'm going to use yesterday's low as that area, okay? Now, Pia makes mention, hey, it's past earnings. True, okay? If we take yesterday's low, less 2%, it's going to give us 86.52, okay? Now, so if you ask most people, hey, what's your favorite trade? They would say things maybe like a bounce setup. Second might be, let's say, a breakout. A breakout could be horizontal or diagonal. This is really underneath the breakout as well. It's just a breakout inside a channel. The uniqueness of this is if it breaks out, a lot of investors are trying to get the stock to go to the next level of resistance. Okay. And sometimes that can happen quite quickly as you have those 4 things happening. New investors are buying potentially. Current investors add to positions to try to actually dollar cost average. Short investors exit the position by buying those shares back or trying to. And short investors actually cover their short and then go long. Now you could say the fourth and the first are similar, but you see a reversal of that type of trend. Day to GTC, day to GTC. Now let me double check that stop just to make sure we're there. We said what, 80, that looks right, 86.52. Now what we're going to do is, you might be saying, well, James, I'm not going to take a full position. I'm maybe just going to take half and try to add. Note it, okay? We're going to go, well, I'm not going to be able to take a full position on that. It's going to be too much. If we took, let's say at the most, it's going to be right around 65 shares of stock, okay? Now, here's the deal. If someone, for example, is buying knee, they're not necessarily buying knee because of what they think the growth is going to be. They're trying to buy knee because of the consistency, okay? They're trying to also maybe buy knee because B also might pay a dividend, does 2.75, has a lower PE, 20.34, and so it's not something that really has the growth characteristic. But you're trying to trade a sector through a stock that has some growth potential, but also some consistency and a trend. That trend over time is not like Micron was, but not everything in the portfolio is trying to be like that. So we're trying to kind of play this at a critical time where it might breach resistance and go to the next level of resistance. We're going to go confirm and send it. Now, the trades that we did here today was knee. What was the other trades we actually did? The other trade that we actually did, let's go back to the monitor page, okay? The other trade that we did was Mo. And what other trade did we actually do? We did 3 of them. Name them, okay? We also talked about some previous areas. Now, the other one I want to kind of keep an eye on, if we said, is there a sector that might continue to maybe get in the action? It might be the utilities. Keep an eye on that. Okay. Now, also coming up next, we have Cameraman with a class on getting started with options. Stay tuned for that. I want to say thanks to Barbara Armstrong for answering those questions in chat. Yeah, Colgate, okay, was CL. That was the third trade. That was a long synthetic. There also is a survey in the chat. It's 2 questions. Please click on that. And thank you in advance for filling that out. And I look at that and use that for material for what we can cover in class. Now, also, last thing I want to share is, can you share these charts with us? I'm going to post the grid in the chat as well. And thank you for that question. Now, remember, with what we talked about was done for example, illustrative purposes only. All investing has risk. Stay tuned for Cameraman coming up next. Don't forget to subscribe to the Trader Talks channel. And remember to give a thumbs up for this video so others can find it as well. And thanks to Barbara. She'll be teaching later on today, so join her class as well with Getting Started with Technical Analysis. Thanks so much. Take care. Bye-bye.